Hello, everyone. This is Jeff Selke of JRS Wealth Management. So excited to have you here today. We have some very exciting things to talk about the markets and the economy and what's going on with Russia, inflation, all sorts of things going on. We just held a webinar and an in-person, actually, event for our clients just a few weeks ago, talking about what was happening in the markets and the economy, but that was before the invasion of Russia into the Ukraine. And therefore, that has changed things. And it's changed the dynamics of the market. It's changed inflation. It's changed a lot of things. And so today we wanted to do this very special webinar for our clients and for your friends and neighbors who you've invited. And we'll be sending this out, hopefully as a recording, so that you can watch it later as well, or send it to people you care about. But I wanted to introduce, again, I'm Jeff Selke, president of JRS Wealth Management. I've got Kurt Brown here on with me, and Kurt is going to go over, he's my chief investment officer. This guy's been working on Wall Street for over 25 years and just done a great job. He knows the markets, I say, better than anybody I know. And so I wanted him to fill us in on what he sees of what's going on in the markets and the economy, and what things that you need to know to prepare yourself and to be aware of what's going on and how this is affecting your investments and the future and what we see ahead, because I know many of you are very concerned about the markets going down, about losses in your investment portfolio. And some people are even nervous, feeling like, man, can I retire in the next couple of years? So I want to give you some reassurance and let you know we're on top of things and we're here for you. And we want to educate you and keep you informed on what's going on and what you can expect. So I'm going to turn the time over to Kurt to talk to us, and then we'll go from there.
That sounds good. Jeff, hey, thanks for having me out, man, and to address our clients and whatnot. I was doing this morning. I mean, now we're going to sound like the old guy. I'm not going to say you're the old guy. I'm going to sound like the old guy. This is my 30th year working on Wall Street.
Wow.
And I was adding up this morning the number of times in the 30 years I've been in the business that the S&P 500 has dropped 10% or more. And this is the 25th time out of 30 years.
25th out of 30 years. Wow.
Yeah. And the reason I was thinking about it this morning, I was thinking every time this happens, and the S&P 500 got down about 15% this past week. Yeah. And every time it happens, it always feels like it's unique. We haven't seen it before, and it feels really bad. And it really does. I mean, it always feels like, oh my gosh, like, is it different this time? Is it different this time? You know, it's like, it's easy when we look in the rearview mirror to say, oh, I should have made more investments when things went down. But then when the time comes and you're in it, it feels different, you know?
It does. And I'm hearing that from many people, just a feeling of, oh, is this the start of a 2008 scenario, yeah, where the market drops 40, 50, 60%. And so just, when we experience this as investors, the market dropping 10 to 15% or even 20%, there's that internal fear that we think, oh my gosh, this is it. This is the start of the crash and we're going to lose all our money.
I know. And it always happens. And then later we look back on the rearview mirror and we're like, I guess I should have just known that these things happen from time to time, but it is hard when you are in it. And a lot of our clients don't know this, but I started my career on the New York Stock Exchange, and then I was a fund manager for 13 years as well. And it's never fun. This is never fun. But what makes it hard is that the media is really not designed to get you good info. They're designed more to kind of scare you so you'll watch and read their channels. So what we want to do is take a few minutes and simply just give you the data around the good stuff and the bad stuff. And there's plenty of both right now. So Jeff, should we dive into it?
Yeah, let's go.
All right, let's do it. Hey, I'm going to turn my video off so nobody has to be distracted by me, and they can just kind of pay attention to the slides themselves here. Okay, so let's dive in. When I was on the floor in New York, legendary floor trader Art Cashin used to always say this when things got really scary. He used to always say, don't bet on the end of the world because it's only going to happen once and the odds are really against it, you know. So Art's passed away here in the last few years, but man, the guy was just a legend on the floor. So let's kind of talk first about what's going on that has got us concerned and what the market is sort of trying to digest here. And there's actually been a fair amount of new information just in the past, call it 90 days. Okay, so number one, obviously, is everyone's trying to assess how aggressive is Putin going to get? How desperate is he going to get, right? Major unknown here. So everyone's kind of trying to factor that in. And I suspect that the first sign that there's some kind of peace agreement or ceasefire or something like that, that there's going to be a real celebration amongst a lot of people for a variety of reasons. Obviously, the humanitarian ramifications, but even global economic ramifications, right? We're dealing with a major commodities disruption. We know what's going on in oil. We're seeing intense volatility there. We had a $40 rally in oil, and a lot of that's been given back in 1 week. We're almost back to where oil was when the war broke out. So it's really whippy in both directions. We also have, I know good inflation seems like a weird thing. We kind of had good inflation, so to speak, because it was the result. Your prices were going up and wages were going up because the economy was so good, was really kind of pushing things higher. We're sort of trading that for some bad inflation. An example of that I'll show you in a second is, take wheat, right? Russia is number one and Ukraine is number 5 in terms of world wheat exports. And together they make up about a third of the wheat market. So, so there's certain markets that are feeling very, very displaced just in the past few weeks. The Fed is really in a box. We're going to hear from the Fed tomorrow. They're really now their job got a lot harder because it was more of a normal cycle that the economy was strengthening, and they were going to have to come in and raise rates to try to cool things off, right? But now there's this backdrop of, okay, but maybe with some of the other things going on in the world, with a spike in oil and commodities prices and a war in Europe, maybe they shouldn't be hiking. Like, you can now make a pretty good case either way. So they're really in a tough spot. So it's going to be interesting to see what the Fed does. Everybody thinks the Fed's going to raise 25 basis points this week, but and that's pretty much baked into the market, but you never know. We're going to probably see corporate earnings and corporate margins get a little bit more strained. We did not see that much last year, but that almost certainly has got to come now as inflation continues to get a little bit more stubborn. And then we've seen the market really trying to digest some excess and some froth in some parts of the market that are much more speculative, right? The SPACs and the NFTs and the cryptos and the meme stocks and a lot of those areas. So let's kind of maybe go through a few of these things. It's no secret to anybody that you've got inflation really running super hot, 40-year highs there. There you see the data on the screen. And as much as earnings were wages, as much as wages were improving for the average American worker, with inflation going up even more, real wages now are actually negative. So wages this year are not keeping up. Even though they've gone up a lot, they're not going up as much as inflation. So those types of things lead to a slowing economy, right? One thing that's really in our camp, though, is that you've got a lot of job openings. That's always very indicative of a strong economy. The problem is, and the reason I have this now in the bad list is because we kind of have a labor shortage. We had 5 years of people retire in 1 year during COVID. So we actually are facing some labor shortages. So it's not as simple right now as the economy is so hot. And that's why you're seeing so many US job openings, right? It's actually a little bit of a labor shortage. That's a problem. We're probably going to see some knock-on effects here from what's going on in Ukraine, right? We talked about the Fed maybe having to be a little bit more dovish, maybe not quite as many rate hikes as we originally thought. We probably are going to have inflation, possibly get worse in commodities before it gets better. And then we see, with a lot of uncertainty, what happens sometimes is consumers get a little bit more conservative. So I'll give you a simple example. The last 2 weeks in Europe, you've seen a massive drop all through Europe, not just Ukraine and neighboring countries, but everywhere in Europe. You're seeing a real slowing in some basic things like getting on an airplane, going out to dinner, how much you're spending on retail, right? So when people get nervous, they have a tendency to sit on their hands and spend less money. So you might have a slowing global economy, not because the Fed's going to raise rates or other central banks are going to raise rates, but just because people are nervous, right? And now we've got new supply chain problems, right? In oil, in wheat, in fertilizer, and things like that. Fortunately, we saw the COVID supply chain problems actually getting better. Companies have been taking down earnings estimates already, but now in the past 2 weeks, we're seeing companies get even a little bit more conservative. So it's all of these things are combining to make people feel short term a little bit more nervous about investments in general, everything from the stock market to housing, et cetera, right? Any investor, and everybody on this call knows this, as investors, we just hate uncertainty. We like, the more we can know, the better we feel, right? I said already, the economic data was actually already starting to cool a little bit. If you've been keeping your eye at all on consumer sentiment, this is kind of how investors have been feeling. And then we've seen actually a real reduction in mortgage applications. We'll talk about that more in a minute. I'm going to kind of skip through that. I brought a lot of slides, but I don't necessarily want to cover each one of them. Here's the thing that I talked about with wheat. Between Russia and Ukraine, you're talking about almost 1/3 of the world's exportation of wheat. That's a major problem. And you can see what's happened to wheat prices just in the past couple of weeks, right? If that continues for a length of time, we're worried, about food shortages in poor parts of the world. This chart in the black line here is simply just showing that agricultural inventories were already low coming into the year. So this thing with Russia and Ukraine is not going to help that, because you've got so many exports that come out of there, right? I touched on this. You're seeing a lot more companies in the blue line there warning that their earnings are going to be a little bit lower than originally anticipated. Now, so far, this is not a big problem, Jeff. This is like, a minor reduction. Right now, it's only 1 to 2% lower in expected earnings for the S&P 500, which is very, very small. It's nothing like the expectations we saw during COVID, which was a massive reduction. So far, just a little bit of softening in earnings expectations, but you don't want to see this bar get way down here, because the stock market will really have to re-rate those expectations, right? Excuse me, I've been battling a little bit of a head cold, so I apologize. But we've got another thing that we find a little bit concerning about what's going on in the market is you've got in the S&P 500 itself, you've got a kind of what we call a top-heavy market. And this happens from time to time. So right now, you actually have the big six accounting for nearly a quarter of the S&P 500. That's a lot. It makes a market that's kind of top-heavy. And then the 494 companies in the S&P 500 are the other 75% of the market, right? So, when we see this, I have a tendency to get a little bit more nervous, because people are getting over enamored with these kind of big companies, right? The darlings. We saw this a little bit in 2000. Now, what's happening in the market in general is radically different than 2000. So I'm only going to make this one comparison here because the reasons are very different. But nevertheless, if in 2000 you thought to yourself, well, I'm just going to buy the biggest 5 companies or the biggest 10 companies, that's going to be my retirement plan, you would have been pretty sorry, because the companies themselves would have done quite well since then, but not the stock prices. So you can see like Cisco and GE and Intel, for example, it's been 22 years and the stock prices are still lower than they were in 2000. And these companies have done a very, very good job of executing on their businesses. They've grown a ton, but the stocks were really expensive. So you want to be careful with the darlings about making them too big a part of your portfolio. Now, the flip side of that is this. You also want to be careful when looking at what your portfolio is doing and equating that to success. Okay, and here's what I mean by that. A successful portfolio is different for every client. And that's why you have good financial advisors like Jeff and his team, because really the S&P 500 might not be what makes my portfolio great. So even me personally, I was a fund manager for a lot of years in New York. And last year, my own personal portfolio, underperformed the S&P 500. Well, by design, that's the case because this year, the stock market is having a really hard time and is down a fair amount, and my portfolio is doing a lot better. So there are times you actually want to be underperforming the S&P 500, right? So you have to be really careful about what it is that you're comparing. And especially when you start getting a market that's really top heavy into just a couple of companies. So I'm putting that out there for everybody to kind of consider that. We haven't seen in a long time a market that's this top heavy into the top 5 or 6 companies. Okay, so let's touch on some of the stuff that we think is really good that's happening out there. First and foremost, earnings, right? And historically, earnings are the real tell in what is happening both in our economy and in the stock market, right? And you look at what these S&P 500 companies are making in terms of quarterly profits, and it's really stunning. I mean, even the growth from before COVID to here, that is a massive amount of growth in some of the biggest corporations in the world. And it's about roughly 9 times where we were during the financial crisis. So in a period of roughly 12 or 13 years, you've grown earnings 900%. That is really, really remarkable. So we, a lot of people will talk about bubbles and a market that got too hot. And definitively, there were parts of the market that have gotten out of their mind. However, overall in the economy and many of our major blue chip corporations, it has been very genuine, legitimate, and powerful growth that we've seen here over the last few years. Another thing that is just fantastic is the current condition of the average household. When we went into both the dot-com peak as well as the financial crisis peak, households were not doing nearly as well. In fact, in those periods, we found households that were using a lot of debt and they didn't have a lot of cash on hand. We are in exactly the reverse position now. So not only is household wealth more than twice what it was before the financial crisis, but you have households using a very, very low amount of leverage. So many people got burned during the financial crisis that most households don't want to borrow a bunch of money. It's really fascinating because interest rates are so low, and so you could borrow very inexpensively and go out and do whatever you wanted to do with that money, right? But most Americans mentally are not in that place. They don't want to borrow more money, even though it's almost free. So the average household in this country is really in a far superior position than where they were going into the financial crisis or going into the 2001, 2002 kind of dot-com bust. Another thing that's really stunning is the amount of cash that's in the system. I mean, the average American is holding significantly more cash than they have ever held as a relationship to GDP. Starting with COVID, we just saw, a real sharp increase that actually, believe it or not, is not reduced. Here's another way of looking at the data. And you can see it here sort of by tranche, right? So the top 10% wealthiest people in this country, look at the amount of cash that they have been stockpiling away. Well, the reason that's so bullish is because they will historically not sit on that cash. That cash will come back into investment assets, right? So even that next 40%, so the top 50% of wealthiest people in this country are sitting on a lot of cash. The banks finally have started lending a little bit more money. So in the fourth quarter of last year, you see that JP Morgan and Wells Fargo, the two biggest lenders, they increased the outstanding loans by 6% and 4% respectively. So a nice little jump in the amount of loans that they were issuing. But look at the deposit increases. So these banks can't even keep up, right? I mean, they're bringing in cash in a way that they don't even know what to do with. I've got some other charts that I don't have in this particular presentation, but banks have never, literally since we've recorded the data since the 60s, have never sat on this much cash. So not only are the corporations and the households in great shape, but the banks themselves are in incredible condition, at least here in the United States. Margins have been very, very strong, right? When I started in my career here, S&P 500 profit margins at 4% were good. Well, look where they are now at 13%. And pretty much for my entire career, everybody has said, oh, profit margins cannot continue. Well, technology continues to make corporations more lean, more mean, more efficient, et cetera. And that's why technology is has been such an amazing driver of global gross domestic product, is because of this right here. Now, I will say we are going to see this come in, right? With the cost of everything going up, it's impossible for these corporations to maintain this, right? But generally, we expect the trend line to continue. One thing that we saw, this data is before the war broke out. It's 6 days before the war broke out. We were already seeing leading economic indicators starting to roll over. We already felt like the Fed was going to have to be less aggressive than they were leading on. So the Fed was sort of banging their chest, like, we're going to raise 6 to 8 times this year. We just don't even see how that's feasible, especially now with what's happening in Europe. So we're certainly going to get some rate hikes here, but the Fed's going to have to be really careful because the economy on its own was starting to do the dirty work. It was starting to slow and cool a little bit, not like an imminent recession, but like a healthy cooling, right? And we actually wanted to see this. You don't want to get an economy that runs too hot. Some of the things that have really been plaguing our economy, like port traffic, right? We got to a place where it was almost a month to unload your ship sitting off the LA port, where now we're getting back down to a much more realistic kind of back to more to historical norms. That's really good. So some of the COVID problems were finally sort of getting worked out. We're talking about earnings here still. The estimates for earnings going forward are excellent. These probably are going to be reduced some just based on commodity inputs and margins in general. But the chart on the right, I want to draw to your attention. This goes back to World War II. And a lot of times I hear people say, well, the stock market is a manipulated mechanism, or it's a Ponzi scheme, or it's a zero-sum game or something like that. But this will show you the relationship between the S&P 500 stock prices and the actual reported earnings. So in other words, how closely aligned are those two things? And you can see, here's what, 80 years almost of history. And look how closely aligned these two items are. So in the short run, markets are kind of crazy. They do weird things in the short term. But in the long term, the reason we obsess so much about earnings is because when you invest in companies, this is really what you're investing in. You really ultimately are investing in their earnings. And sometimes one or the other of these gets too detached, right? So these two will snap back in line with each other. But that's a really, really important relationship. We think we're about to see some major improvement in housing prices. And when I say that, I'm not talking about a correction. I'm not talking about anything like 08. It's nothing like that. But we really had a major housing shortage in this country. But look at building permits. We're getting back to we're getting near a 20-year high again in building permits. Look at this one. This is housing units under construction, right? Look at this, going back to the 70s. So we're really having a nice building boom here. And again, we badly need this supply. And then here's units authorized, but not started yet, right? And look at how long it's been since this one hit this level. Same kind of thing, back to the 70s. So over the course of the next year, we're going to see a lot more supply coming online. And we need that badly. We need a national housing market that has a more efficient clearing price than the sort of insanity that we're in right now. We do not feel we are in a bubble in housing. It's literally a shortage. And so it's gotten very complicated. But this is actually promising for the housing picture. So Jeff, one of the questions that we get all the time, I know you do as well, is, hey, the market's been sliding since January 4th. We're call it 10 or 11 weeks into this sell-off. Where's the bottom? How do we know where the bottom is? Well, I like to share this sometimes. This is a checklist that guys on the floor of the New York Stock Exchange use. When I went down there as a punk kid 30 years ago, this was sort of the working checklist here. When a market really starts sliding hard, what are you kind of looking for as signs of a real bottom. And usually what's happening is you're creating a psychological event, not a fundamental one, right? What happens is emotion begins to take over. And so you're looking for signs of sort of emotional capitulation. You're looking for people that are saying, just get me out at any cost, right? And so you're looking for, days where all of the volume is selling, or you're looking for explosions in the VIX, right? People aggressively purchasing protection on their portfolio. You want an environment where everyone is scared to buy. I've noticed over the years that, when people are coming on TV and yelling that you should be buying, you're probably not at the bottom yet. A lot of times you even get these high-paid professionals on TV saying, get out of stocks and things like that, right? You get more of that fear and that panic. When we start to see that, we start feeling like we're getting closer to a bottom. It's happening. We are definitely starting to see some more signs of stress. You see what's happening in the Chinese market the last few days, and we're starting to see junk bond yields widen out some and things like that. So, our team feels like we haven't seen much in the way of a lot of fear yet, but we're definitely working our way there. One thing that I wanted to draw your attention to that's kind of interesting is how much damage has actually been under the hood. The stock market, or the S&P 500 being down 12 to 15% like it's been over the past week, is not really telling the full story. If you look at this, 2/3 of the S&P 500 is down 20% or more from its high. And if you look in small caps, for example, 85% of small cap companies are down 20% or more. And, more than a third are down 50% from their high. So under the hood, the average stock is actually down a lot more than you might see in the headline. And so a lot of the damage, quote unquote, has already been done. A lot of very negative news has already been priced in. And some things that we felt like were very expensive, Jeff, even, 3 months ago, certain stocks and sectors that looked very pricey are actually starting to look cheap. There's some very interesting things starting to screen for us in terms of companies that suddenly look cheap after a few weeks. So we're definitely getting to a more interesting place. You hear us a lot, and I know you hear Jeff and his team a lot talk about owning really high quality assets. This is important. And what you're looking at on your screen is exactly why. Over the last couple of years, there's been a lot of really hot sectors, whether it's SPACs or the meme stocks, sort of the fad stocks, or the crypto complex, or all the really up and coming, tiny, unprofitable tech companies. Well, you can see by looking at the screen there, a lot of these sectors have been really, really hammered. And there are a lot of stocks that are down 60, 70, 80%. So it's one of the reasons that we obsess about owning really high quality assets. And even then, it's not fun to go through times like we're going through right now. But man, you look around at stuff like this, and this was the stuff that your neighbor was bragging about a year ago and how much money they were making. Well, they're not bragging about that right now in their NFT portfolio or whatever they might have. So, and there's certainly a place for speculation in people's portfolios, but you want to be really careful chasing things that are faddish or trendish. I remember when the SPACs first came to market, it seemed like it was this great, brilliant idea. But actually, most of the SPACs are down 70% or more now. So again, it's just something you want to be careful of. When you look at the recent sell-off, for example, the lowest profit margin companies are actually down 60%. Well, that is really a far cry from the highest profit margin companies, maybe that are down 15 to 20. So again, we really emphasize high quality. And there are going to be times where your portfolio, if you own high quality assets, might not be doing as well as your neighbor, but at the same time, you should be able to sleep better at night, because when times like this happen, you're going to be doing a hell of a lot better. One thing that was really bothering us, but now is actually getting more interesting, is the market was getting really expensive. But now we're getting back in here, not cheap. We're not cheap here, but we're definitely getting back to more normal levels, at least normal over the past 5 to 8 years. So that is one good thing about what's happening now is the market isn't nearly as expensive as it was. Same thing here in the NASDAQ. Even with the really high growth parts of the market, we're back to, where we were 5 or 6 years ago. And so that's, again, it's a good thing because the market was really getting expensive. A couple of things that are interesting I want to put on everybody's radar just to think about as we go through times like this that are kind of stressful is that volatility is a really normal thing. In fact, every year and a half, the market for the past 70 years has a 10% drop. Every couple years, a 15% drop. And then, even a 20% drop every 4 years. So this actually isn't really that far out of the norm, right? Another way of looking at this are the red dots here. So this goes back, 40, 42 years. And you can see most years here, the market's actually up. But the problem is the red dots show you what the average drop is during the year. So the S&P 500 has an average 14% per year drop. And again, we got down 15% a few days ago. So at this point, regardless of what the cause is, so far, this is actually kind of a normal year. Again, like I said at the beginning, it never feels normal when it's actually happening. A couple of the things you might find interesting. And this, Jeff, was some of the data that I was looking at earlier. Here's where I started my career back here in 1990. But if you look, this is every single 10% drop in the S&P 500. Well, look at this. If every time we go through one of these corrections, you look at what the next 2-year returns are, look at this. The average return is 37% over 2 years. So historically, with a few exceptions like that 01 and that 08 period, these things usually get rectified relatively soon. So it's the kind of thing you want to be careful not to get too cute with. Even if you move to the sideline, you maybe don't want to move to the sideline for too long because the forward returns have a tendency to be really good. 25% for 1 year and 37% for 2 years. That's exceptional. And you can see some of the sizes of the drops, at least in these 30 years I've been in the business, and they're all scary as heck when they happen. But then in retrospect, you're like, my gosh, these were some great buying opportunities, Let me show you. I'm going to skip over a couple of these. Another thing that's kind of interesting is midterm years. Going back 70 years, every single midterm year has had a tendency to be a lot more volatile than the average year. So the average drop during a midterm year has been a 17% sell-off. But look at this. Just 1 year later from the sell-off, look at the return. That's about one of the best 1 year returns of any data set you can find. So midterm years historically have been very volatile, but they've actually proved to be great buying opportunities. One of the reasons this happens is because midterm years sort of present a lot of uncertainty. Anytime you go into these election periods, it gets people up on edge, not knowing what the future is going to look like, right? And again, markets really hate uncertainty. I want to put in a note over the last few years, heard a lot of people talking about things they don't like, bonds or value stocks or international stocks, or now we have people talking about growth stocks again, right? It can be very tempting when a certain asset class doesn't do well for a couple of years to want to abandon it. And one of the things that I know that, Jeff, you talk to with your clients about is if you build a holistic portfolio, the assets in that portfolio each serve a different important role. And so you want to be careful not to abandon things. Like, for example, in the last 6 months coming into this year, we had a lot of clients calling and saying, I don't think I should ever own bonds because interest rates are so low. I think maybe we shouldn't hold any bonds, right? So, but now look what happens. You have a nice drop in the market, and this would be a great time if you had some bonds, maybe to be able to sell some and do some rebalancing and be able to buy some things that go on sale. And so that's why people in our business are so particular about trying to keep a balanced set of assets. And they act different at different times and for different reasons, right? The value stocks have been abysmal for a very long time. And now the past few months, they look great because that's the part of the market where suddenly there's a lot of, sort of interest in, right? Whether it's the oil stocks or the bank stocks or whatever it might be. So I'm going to skip over a couple of these things. One thing you might find interesting, I have had some people question some of their fund managers, some of which are really top tier elite money managers. So the big investment bank Baird has this really interesting study, and there's several different firms out here that have done studies like this, but they took the top 5%, the most elite of all stock fund managers historically in the United States. And they looked at, and they got it down to just a pool of 155 managers, 155 funds out of the thousands that are out there. And then they looked at their performance historically. And here's what they found that was super interesting was if you go out over a longer period of time, almost none of the managers underperform their benchmark, right? Because these are the best of the best. But what's interesting is that in the data is even the most elite of money managers in any 1 year period have about a 40% chance of underperforming their own benchmark, which surprises a lot of people. So the only reason I bring this up is because we have some fund managers we work with that have 30-year track records of outperforming their benchmark, but occasionally will have a 1 year period where they don't. So it's a little bit of a word of caution to say, hey, sometimes that's just par for the course, right? Even with the very best of the best. So let me close with this, just in terms of a summary, if you wanted it all in kind of one shot, is here's what's really good that's happening. Earnings are exceptional, and our economy overall is in really, really good condition. The labor market's great, probably too hot. There's cash all over the place. We talked about that. Interest rates are still incredibly low, okay? Even if the Fed raises by a full point over the next 90 days. Historically, we are still at incredibly low levels in terms of where interest rates are at. The Fed is probably going to stay very accommodative, especially if there's something scary like a war going on. We talked about households, we talked about corporations, and we talked about banks. All came into this period in really, really great condition. Okay, so what don't we like? The inflation, right, is persistent. We have a global economy that got too hot. We've got to figure out how to rein that in, right? Putin is a major wild card. We just don't know how desperate he is. It's impossible to model things like this. What about China, Taiwan? I get that question every week. I don't know, right? You don't know when, you don't know if. These geopolitical events are very, very hard to model. However, historically, geopolitical events have only weighed on the market for a few weeks. And then what happens is everybody sort of gets back to asking the same basic questions. How much money are corporations going to make? And so it's hard to do sometimes, but we have to put the humanitarian aspects aside if we're only assessing the investment landscape. Because take, for example, Russia and Ukraine. Even though Russia is a large country, they have very, very little influence on global GDP. It just doesn't move the needle a whole lot. So you have to be a little bit careful when you're looking through the geopolitics as it relates to your portfolio specifically. The Fed, we kind of talked about them being in a box. We're a little bit worried about that. They'll probably do the right thing. We talked about how there's some junky assets built up. You got to be really careful, stay high quality. These three things have worried us for several quarters, but we're feeling better about them. Investors suddenly are less complacent for obvious reasons. The markets are getting cheaper. They're not cheap yet. And we're finally seeing a lot of these niche parts of the market get rectified where there was a lot of excesses and kind of silly investing going on. And finally, in terms of a game plan, we just want to encourage everybody to stay kind of on top. Avoid complacency. Don't abandon the important assets like we talked about. These are biggies, knowing what you own and why you own them. It'll allow you to sleep a lot better at night when we get into these periods of high volatility and stress, right? Again, you want to own these high quality assets. I know I'm kind of like beating a dead horse there. That's a big deal. When you go into a recession and the bankruptcies start, you're going to want to know that you own companies that are bulletproof. And unfortunately, sometimes the trade-off is you might not make quite as much money in certain types of up markets. Okay. But those high quality assets, they will come back and they will reward you in hard times, right? Expecting that volatility is a big deal. We talked about that. You might want to consider alternatives, everything from insurance and annuities, like non-correlated assets, other types of private credit or private equity and things like that. Not every solution is solved in the public stock and bond markets, obviously, right? And then, maybe take advantage of volatility. In your taxable accounts, you might be able to harvest some losses intentionally and put those in your pocket. They roll forward forever, unlike the old days. You also might want to rebalance and buy some assets that are on sale. So, Jeff, I'm happy to take questions or whatever, or sort of enumerate on anything else, but those are my prepared comments.
Okay. Hey, Kurt, that was awesome. Thank you so much. So let me ask you, with your 30 years of experience on Wall Street, dealing with the stock market, what would you say to my clients and investors who have experienced a horrible last 3 months? They're feeling scared.
Yep.
Kind of a summary. I think you've said a lot in this presentation, but what would be your final words to them where they're nervous, worried about, hey, I've lost 10 to 20% already. I'm afraid of losing more.
Yep.
And I've owned high quality, I've owned good stocks, but they're just getting beat up. What do I do?
And I skipped over a slide actually that I'll just have on the screen while I'm talking here. But I know people get frustrated with financial professionals that say, just stay the course. That doesn't feel good. That doesn't sound like a good answer. Frankly, Jeff, I don't like the answer. Okay. But here's the reality. There's two major things here. One is that time frame is everything. If you tell me that you need this money to pay bills, send your kids to college, right? Pay your rent in the next X amount of months, you got to sell. You can't afford to take risks because the market can go lower. Okay. But if you tell me this money that we're talking about, I don't need for 5 years, then I'm going to tell you, you must stay the course, because like you're looking at on the screen, to say to me, this time is different, is to disagree with 500 years of economic history. And by the way, with things way scarier and more dangerous than what we're seeing today, like much more dangerous. In 2008, when Lehman Brothers and Bear Stearns was collapsing, and frankly, we were one day away from Morgan Stanley going down and Bank of America. Okay. That's way scarier than what we're looking at today. World War I, World War II. I mean, we can give you a list, right? Cuban Missile Crisis. I mean, there have been some very, very scary events in time. So time frame ends up being the ultimate arbiter to how patient you can be. So if you have some time and you own high quality assets, that's the second thing. If you own garbage, and there's a lot of garbage that trades in the system, Jeff, there's a lot of companies that actually, they must borrow to stay afloat. I hate companies like that. There is no wrong time to sell those. Get out of them. In fact, I tell clients all the time, any investment you don't like, get out of it. Like right now, the economy is so good and there's so much liquidity in the system that even if your investment that you hate is the investment in your cousin's dry cleaner, call and get out of the dry cleaner stock. Like get out, right? But once you have a portfolio of really high quality assets and you don't need that money in the near term, that's when you have to choose to be patient, sort of stay the course.
Perfect. Yeah. One of the things I always encourage our clients is, always have some safe money. If we have safe money, we can sleep at night. We can know that, hey, let the markets do what they're doing. If it's the end of the world, one, there's nothing we can do about that. But number two, if it's not, things are going to work themselves out and things are going to be okay. And we're making adjustments. We've made adjustments this year already in the last few months in our portfolios for our clients to add more value names, more energy stocks, different things that we think can do well in bad times. And that's helping. But this is just it's a rough time. And I love those slides that you showed in that data that shows, historically speaking, the market a year from now, 2 years from now is most likely going to be higher. We can't say what's going to happen because nobody knows what's going to happen. Nobody knows what Putin's going to do in Russia and what's coming next. But the truth is, historically speaking, the market's probably going to be higher a year or two from now. And so it's important to stay the course and stay invested, although we're diversifying, and it's okay to take some chips off the block, especially if you need the money in the next year or two, then that's different. But if this is your retirement, if this is your money that's, 5 years out, or we're going to be using some of this over the years, then we can be a little bit more long-term and let our money grow and, be there invested for the long term. And so stay invested. And if you have any questions, any specific questions, concerns, feel free to email me or call our office. Happy to answer your personal questions at any time.
Yeah, that's right. And, we as humans are very, very prone, all of us, no matter how experienced or smart or anything we are, we're prone to recency bias. So if I go back to last summer, people were too positive. Yeah. Everything was great. You can buy anything you want. You can, the crap I saw people buying in their portfolios, my neighbor told me to buy this. Every time it happens, you don't know when the market's going to have a correction, but people are setting up for a correction. The problem is the same as true in reverse. When things get hard, every single thing we see is bad. And so we actually stop looking at the good and we're only looking at the bad. I'm starting to see that. I'm turning on the television and all I'm hearing now is all bad. Like we just went from too much good to too much bad, The other thing is it feels like it's always different this time. But the other night I was sitting at home and I was thinking, I went back and I made a list of every time in my 30 years that somebody has truly been worried about a nuclear bomb being used. Because in the last couple of weeks, what are we all worried about? Oh, Putin's going to go crazy. He's going to launch a nuke into Europe somewhere. And, okay. But you know what? This is like the 12th time in my career that there has been a legitimate concern that some government is going to use a tactical nuke against somebody else. Okay, I'm not saying it couldn't happen. I have absolutely no idea. But to bet that direction is to bet on something that's never happened. And I mean, you're really, really going to play your hand in a dark place, right? And I'm not saying don't do it. I'm just saying you really have to be betting against history and against the data,
Yeah, it's so true. So again, thank you so much for attending this webinar. We wanted to get you this important information, this timely information about Russia, inflation, the economy, the stock market, what's going on, where the average person is down probably 15 to 20% in their portfolio. Yep. This is a trying time. It's a scary time, but it's normal. This is what happens, as Kurt showed these slides and talked about. Historically, this happens again and again, and it doesn't mean this is going to be a bad year. It's just been a bad 3 months. But things can change very quickly as things hopefully resolve themselves in Ukraine and in Russia. And we'll be watching closely and make sure we're managing your portfolio in the right way. So anyway, thank you so much for coming. We will provide a recording for this so you can watch it later or send it to friends. And hope you have a wonderful evening and a great week. And we'll talk soon. Take care.